Welcome. In this video, when will Xcn coin start moving? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. When the chart is examined carefully, it is clearly seen that the price movements have been compressed within a narrowing and downward structure for a certain period. This structure is a falling wedge formation, which is frequently encountered in technical analysis and presents significant opportunities for investors. The falling wedge formation typically appears during downtrends or corrective phases and is often a strong technical indicator of an impending trend reversal. The current falling wedge formation on the chart closely matches the classic characteristics and could signal a potential upward move for those observing closely. When analyzing the formation process of a falling wedge, it is observed that each new high and low in price occurs at lower levels, but these movements take place within a gradually narrowing range. This contraction is a sign that selling pressure is decreasing and buyers are slowly beginning to gain control. So although it may seem that the price continues to make lower lows, the underlying momentum is weakening, selling strength is fading, and a potential reversal move is taking shape. From a technical analysis perspective, falling wedge formations are typically considered bullish reversal formations. This means that when the formation completes and the price breaks above the upper boundary, it often signals the start of a strong upward movement. The falling wedge formation currently visible on the chart appears to be very close to an upward breakout. Especially the fact that the price has touched the upper boundary multiple times and received strong reactions from that area indicates that this resistance line is weakening and the likelihood of a breakout increases each day. For investors, these types of patterns hold significant potential. The breakout from this compression pattern usually triggers a sharp and fast price move. Particularly in upward breakouts, investors who were previously uncertain may re-enter the market, accelerating the buying wave. This results in upward momentum immediately following the breakout of the formation. Therefore, if the current falling wedge formation breaks to the upside, the probability of the price reaching its target levels is quite high. The post-breakout targets of such formations are usually measured by the height of the widest part of the wedge. That is, the distance from the widest point within the wedge gives the potential price target in the direction of the breakout. Considering this height in the current chart, there appears to be a highly attractive and rewarding upward potential for investors. Additionally, reaching this target zone represents not only a technical level, but also a psychological threshold. Such reversal formations give the market a new direction and strengthen investors' belief that the trend has changed. Looking at the internal structure of the formation, the decreasing volume during each down move and increasing volume during attempted rises is also a very positive sign. Volume analysis is a crucial parameter for confirming formations. Decreasing volume within a falling wedge structure indicates that the downtrend is weakening and selling pressure is no longer dominating the market. If a significant increase in volume is observed during the upward breakout, it confirms the formation and suggests that the rise will be stronger and more sustainable. From the perspective of investor psychology, the falling wedge formation is quite notable. This pattern is also known as a patience formation. The gradual narrowing of price movement causes many investors to remain undecided and move to the sidelines. However, when the breakout moment arrives, market uncertainty fades and rapid buying waves drive the price sharply in a new direction. But we cannot make decisions based solely on formations. Let's now take a look at other metrics. Stay tuned. The Elliott wave theory is a powerful and time-tested technical analysis tool that allows investors to track the traces of market psychology and collective behavior left on charts. Applying this theory to long-term charts is particularly important for predicting major trend movements in the future. In the current long-term structure under review, it is observed that the price is going through a horizontal correction phase within the second wave. From a technical analysis perspective, this indicates a healthy consolidation phase and could potentially signal the beginning of a much larger third wave. According to the Elliott wave theory, price movements consist of 5 main waves, 3 impulsive, aligned with the trend, and 2 corrective counter-trend waves. The strongest among these is the third wave. Many investors do not want to miss the third wave, as it is typically the phase where the market moves with the highest volume, the steepest upward movements are seen, and investor sentiment shifts most rapidly to the positive. In the current long-term structure, the time spent in the second wave means that the foundation for a larger move is being laid. Second waves are often periods when investors are in a decision-making phase, the market is attempting to recover, and weaker hands are flushed out. Therefore, the horizontal and consolidative structure observed during the second wave is highly beneficial for shaping a long-term uptrend in the healthiest way possible. The horizontal movement within the second wave may continue for a while. However, once this period ends, the third wave is expected to begin. Theoretically, this third wave is often expected to reach at least the 1,618 Fibonacci extension level, and in some cases, may even extend to 2,272. These types of extension levels indicate a strong upward trend in price and can offer major opportunities for investors. Especially when looking at similar past formations and Elliott wave examples, it is clearly observed that third waves are typically one of the fundamental structures that determine the direction of the market. The prolonged horizontal behavior during the second wave indicates that confidence is still being built in the market. During this time, investors usually price in news flow, macroeconomic data, and other external factors. Simultaneously, strong support zones are tested, and the price holding firm at these levels becomes a critical signal for the initiation of the third wave. From a technical standpoint, this horizontal consolidation should be seen as a phase where buyers are gathering strength while sellers gradually lose their influence. This helps explain why the third wave tends to move so powerfully and sharply once it begins. When the third wave starts, the price typically surpasses previous highs rapidly. This breakout builds investor confidence and encourages market re-entries. Especially investors who waited on the sidelines during the second wave re-enter the market at the start of the third wave. At the same time, new investors who notice the upward movement also join the trend. This collective participation causes the third wave to expand quickly. Therefore, the third wave represents not only a technical breakout, but also a psychological turning point in the market. Identifying and evaluating such structures at the right time through technical analysis can offer significant advantages for investors. On long-term charts, the targets of the third wave are important, not only as short-term take-profit levels, but also for establishing strategic positions. The 1,618 and 2,272 levels are typically the main target points for such positions. RSI, the Relative Strength Index, is one of the most widely used momentum indicators in technical analysis and one of the most trusted by traders. This indicator measures the degree of buying or selling pressure in the market and makes it very easy to determine whether the price is in overbought or oversold territory. An RSI below 30 usually indicates that an asset is oversold, while an RSI above 70 indicates that it is overbought. However, in addition to these basic boundaries, the trends and support resistance zones that the RSI forms within itself are also very valuable for a trader to predict market movements. In the current situation, a rising trend line observed on the RSI is a very positive signal for traders. The RSI can form technical patterns of its own, although not as many as the price, and these patterns often signal earlier than price movements. In the current technical outlook, the RSI is moving on a trend line with a clear upward bias. This trend line has been tested several times over time, and after each test, the RSI has reacted upwards and gained strength. This indicates that there is still a strong buying appetite deep in the market. We should check the RSI trends in the meantime. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.